Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Zach Guzman on this Monday. We are 90 minutes into the trading day and we're seeing stocks pulling back as investors brace for a shift at the Fed. Right now, all three major indices in the red, with the Dow, the biggest laggard here, down about 0.8%. The Nasdaq down about 110 points, while the S&P 500 is down 29. We're also seeing bond yields edge lower to start the week ahead of that FOMC meeting. Apple's march to $3 trillion. The tech giant closes in on a key milestone. Stock up slightly, but is there more runway ahead for the company? We'll be discussing that in just a bit. Plus, the U.S. inches closer to a grim milestone on COVID-19 with nearly 800,000 lives lost. Leaders across the country reconsidering new restrictions as new COVID infections soar 40% in just 2 weeks. First, though, we've got a very busy week ahead with all eyes on the Federal Reserve. The central bank kicking off its two-day policy meeting tomorrow, and investors are expecting some shifts to its asset buying program and language on inflation. Let's bring in Yahoo Finance's Emily McCormick with a preview on the week. Emily.
Well, Pico, as you mentioned, the big focus for this week is going to be on the December Federal Reserve meeting and monetary policy statement. So there are still some other major economic data releases and earnings reports that we should keep in mind as well. Now, for a quick overview, the economic data for the coming days will include the Producer Price Index out tomorrow morning, which is another inflation report coming on the heels of the hottest consumer price index we've seen on a year-over-year basis since 1982 that came out last week. And then we'll also be getting the Commerce Department's November retail sales report out on Wednesday, which is expected to show a fourth straight month of sales increases in a positive sign for the holiday shopping season. So this would be a little bit of a deceleration after a 1.7% retail sales increase across U.S. Retailers in October. But again, that Fed decision is really going to be this week's marquee event. That monetary policy statement and press conference with Fed Chair Jerome Powell will take place Wednesday afternoon, and many investors are expecting to see the Fed announce it's doubling its pace of tapering of its asset purchase program. Recall that originally these purchases had taken place at a rate of $120 billion per month. Throughout the pandemic, they were dialed back by about $15 billion per month in each of November and December, and now we're likely to see the Fed actually increase that pace of drawdown for its tapering to $30 billion, given especially that persistent inflation that we've seen across the economy, which many officials, including Fed Chair Jerome Powell, have really underscored recently. Now, this Fed meeting is also significant in that we'll be getting an updated summary of economic projections, or dot plot, which charts out FOMC members' expectations for future economic conditions and interest rates. And the last time we had a dot plot was back in September, and at the time it did show that FOMC members were split on rate hikes for 2022, with 9 members seeing the case for no rate hikes next year, but the other 9 seeing at least one hike. But of course, we have been getting additional economic data in the months since then, so likely going to be getting an update on that front as well. But turning back to our calendar of events for the week, also want to highlight that we'll be getting a couple of key earnings results from some bellwether companies as well. Lennar's report will be out on Wednesday, and that company's report does tend to be a good indicator of housing market conditions, something to watch on that front. And then we'll also be getting a quarterly report out from FedEx on Thursday for an updated look on how the holiday shipping season is holding up as well. Then finally, we'll be getting the first report out from Rivian since its IPO last month. So guys, really, again, a busy week here when it comes to both economic data, the Federal Reserve decision, and quarterly results from some of these major companies, people in that.
Okay, Emily, with just a few more weeks left in the year. Thanks so much for that. Let's bring in our first guest for the hour. We've got Joseph Minarek, Committee for Economic Development of the Conference Board, Senior Vice President and Director of Research. And Joe, it's always good to talk to you. The Fed chair has been getting some heat since in that congressional testimony, he essentially said publicly that he no longer believed that inflation was transitory. What should we expect in this meeting in terms of the shift in policy from the Fed?
I think the consensus is where Emily was a moment ago, that they are going to accelerate the taper of their purchases of private assets and probably hint at the likelihood that they will begin to raise the federal funds rate, the typical Federal Reserve policy rate, earlier on than had been anticipated in the past. So we will see a more hawkish Fed on prices, and that's, I think, pretty much baked in the cake at this point.
Yeah, Joseph, back here. Good to be chatting with you again. I mean, when we look at maybe how the bond market is looking to hikes in 2022, looks like 3 are priced in right now. When you think about what's causing maybe the hawkish tilt, is inflation staying high beyond what the transitory take was earlier. And you got two camps there. A lot of people may be focusing in on the supply issues and what's really been going on, versus some who have, pointed to larger fiscal spending. I mean, if you think Chair Powell's timeline is right, in 2022 we might start to see some of the COVID issues roll off. I mean, how does that maybe impact the expectations that are clearly rising for interest rate hikes next year?
You're absolutely right. I mean, the issue for the Fed is inflation. The issue for inflation, as far as I am concerned, is really the pandemic. And, we discovered the vaccine a year ago. Everybody was looking forward to putting the pandemic down. For various reasons, we haven't gotten there. And the pandemic continues to mess up our economy in a number of respects. It has slowed or broken supply chains. It has induced workers to leave the workforce, in some instances with older workers, probably permanently. And therefore, it has tightened up the markets for goods. It has tightened up the market for labor. It has raised the cost of doing business for service businesses beyond labor because of the precautions that they have to take because of the pandemic. So it's been a kind of a perfect storm in terms of inflation. And then, of course, as you erode people's prior expectations that prices were going to be stable essentially forever, that makes it more expensive, and it raises the possibility of greater inflation going forward. The financial markets are reacting to that, I think, fairly predictably.
You just highlighted some of these cost pressures that you think are going to be more persistent, but there's also the element of things that we have seen play out as a result of the pandemic. You've kind of pointed that out there. We've heard more recently from the White House about some of the supply demand sags, especially over with the port stats starting to improve. We've heard from some business leaders pointing to that as well. How much of what we're seeing right now, or what elements of what we're seeing right now, are more temporary and likely to ease up in the months ahead?
I think for economists and for financial market experts looking at current developments, you're probably seeing a great deal of optimism in terms of inflation eventually going away. The markets are, for goods and even for services, are intensely competitive on a global basis. Technology has been advancing rapidly, and if anything, technology advancements have probably been accelerated in the pandemic because of the pressure for communications, virtual meetings, and so forth. If we ever could get this pandemic behind us, a lot of, not all of, but a lot of the pressure on prices currently would, I believe, go away. And as a result of that, we would get down to lower rates of inflation, and people's expectations would be brought down as well. It's just a question of getting there, and there is this frustrating failure to do the things that we need to do and that we know we can do to help to get the pandemic put down finally.
And to what extent do you think some of those price pressures you're talking about can, in fact, be alleviated with a slowdown in those, or tapering in the asset buying? We're not talking about rate hikes until what looks like, Q2 next year potentially, but with so much criticism on the Fed and potentially Jay Powell being behind the ball, how much of this do you think can actually be eased up as a result of tapering?
Many economists will probably tell you, looking back all the way to the oil price shocks in the early 1970s, that macroeconomic constraint to deal with supply problems is an inefficient tool for slowing the resulting inflation. Sure, if you reduce demand in markets, as a result of that, you will have somewhat less upward pressure on prices, but you will be paying a higher price in terms of reductions of output and employment than you would be if you were dealing with a conventional kind of excess demand inflation. So the Fed, I believe, has a sense that it needs to act to provide greater confidence that it is on the case, that it is not ignoring the issue of inflation, but it is going to be more costly to deal with inflation that way than if we could find ways to address those market problems and those supply problems. And that's a very hard thing to do. The administration, the Congress are all looking for ways to try to make supply chains work better. Obviously, private firms are working on that as well because it's their money on the line, not to ship their goods and get their sales. But there are a lot of associated issues with that. The tightness in semiconductor markets, the tightness in the market for skilled labor, including drivers for transit rates and so forth. So it's a tough nut to crack.
And all the more, I guess, pressure put on the Fed here as we approach the last meeting of the year. We'll see how language maybe changes around all that too. But Joseph Minner, Committee for Economic Development of the Conference Board, Senior VP and Director of Research. Appreciate you coming back on here to chat with us today. Thanks again for the time. Speaking of time, we want to note Time Person of the Year being named here today. None other than SpaceX founder and CEO at Tesla, Elon Musk, getting the nod there. In the article naming Musk Time Person of the Year, Time saying, quote, few individuals have more influence than Musk on life on Earth and potentially life off Earth too. I want to play a little bit of what he told them in that big reveal. Take a look.
If somebody makes better cars than we do, then and they then sell more cars than we do, I think that's totally fine. Our intent with Tesla was always that we would serve as an example to the car industry and that and hope that they also make electric cars so that we can accelerate the transition to sustainable energy. I'm confident in the future of Tesla that it will do well, and I hope some of these other companies do well too.
There you go. I'm talking about more of the Tesla piece of what he spends his time on. Of course, a lot of attention has been paid to the SpaceX piece this year as they continue to make progress in space travel. And of course, Elon Musk getting the nod, joins the likes of Mark Zuckerberg and Jeff Bezos as two other tech pioneers to grace Time's cover for Person of the Year. Of course, coming off of Joe Biden's and Kamala Harris's split nod last year.
Yeah, it's interesting to hear Elon Musk talk about the competition in that way, because remember the argument before was that even though Tesla was leading in EVs, the more legacy plays like a GM as well as Ford are going to catch up quickly because of the scale that they have. That hasn't necessarily been the case, and Tesla continued to pave the way, at least in this space. The stock, though, down today, we should mention about 5% almost there. Something that's necessarily related, but worth noting there. Coming up, new COVID cases surge in the U.S., while the U.K. reports the first death related to the Omicron variant. We've got the very latest on the COVID-19 outbreaks across the world on the other side. We'll be right back. Well, Omicron concerns continue to linger as the COVID variant spreads quickly across Europe and the UK. Here in the US, new infections have shot up 40% in the last 2 weeks. Bringing Yahoo Finance's Anjali Kamani with the very latest. Anjali.
That's right, Akiko. Not only have cases increased, but we've also unfortunately gotten very close to a new milestone of more than 800,000 deaths in the U.S. overall since the start of the pandemic. Various trackers have been reporting that we've actually already surpassed that or will by the end of today. That, of course, has really created a lot of concern with health experts who are advocating for continued vaccinations as well as for boosters. Dr. Anthony Fauci saying over the weekend that getting a booster will provide the best protection, even though the U.S. is not ready to change the definition of fully vaccinated to 3 doses or 2 in the case of Johnson & Johnson. Here's what he has to say.
I think if you look at the data, the more and more it becomes clear that if you want to be optimally protected, you really should get a booster. And I think we'll be continuing to evaluate what the official designation is. But for now, if you want to be optimally protected, absolutely get a booster if you've already had your primary vaccination.
Meanwhile, we know that across the pond in the UK, they're really seeing an increase not only in cases and hospitalizations, but they reported the first death, prompting Prime Minister Boris Johnson to say that we should stop thinking of this as a mild variant. So that's the first Omicron-related death reported there. Meanwhile, down in South Africa, the president, Cyril Ramaphosa, has tested positive for COVID, and that, of course, we know is an area which is still struggling to get vaccines. Meanwhile, back over here in the U.S., Philadelphia just announced that they're going to be requiring vaccines for anyone entering indoor spaces that include restaurants, casinos, stadiums, etc. So that mandate is going to start by January 3rd, right after the new year. So a lot happening in this space right now. Back to you.
All right, Anjali Kamani, thanks so much for that. Anjali just mentioning the new restrictions in place for Philadelphia. Let's bring in Dr. Paul Offit, the Vaccine Education Center Director in Children's Hospital of Philly, attending physician in the Division of Infectious Diseases. Doctor, talk to me what it is that you've seen in your emergency rooms. We've heard so much about case counts going up among kids, particularly those that aren't vaccinated.
Right, well, there is a surge among children, about a 30% surge, and I was on service about a week and a half ago, and during that week that I was on service, we saw a lot of children admitted to our hospital. Most were over 5, many were over 12, and certainly there were a handful that had to be admitted to the intensive care unit. What all of those children had in common is, although most of them could have been vaccinated, none of them were, nor were their parents, nor were their siblings. So, we talk endlessly about booster dosing, but the fact of the matter is the real problem, I think, right now in this country is that we need to vaccinate the unvaccinated. That's the issue.
Dr. Anjali here. I want to talk about that death in the UK because it seems like that really shifts the tone and the concerns, even though largely speaking here in the US we still see just milder cases from Omicron. And we're still looking at the winter surge to be largely Delta. Does that make it more concerning for you in terms of how you think, especially about the unvaccinated, but largely speaking, how Omicron might hit the US?
Well, I think people should be reassured, frankly. If they've received 2 doses, for example, of an mRNA-containing vaccine, I think they're very likely to be protected against severe disease caused by fungi. I mean, the kind of disease that causes you to go to the doctor's office or go to the hospital or go to the ICU. I think the additional booster dose offers protection against mild and low moderate infection, but for only a certain period of time. I think we were seduced in many ways by those phase 3 trials that were presented a year ago to our FDA's Vaccine Advisory Committee. Those were big trials, 40,000 for Pfizer, 30,000 for Moderna, but those were 3-month studies. I mean, those people in that trial had all received recently their second dose. So protection against mild illness was 95%. There's no way that was going to hold up over time because neutralizing antibodies fade, protection against mild illness will fade over time, and that's what the booster provides. It provides additional protection against mild illness. But again, I think we're not going to boost our way out of this pandemic. What we need to do is find a way to vaccinate the unvaccinated, and don't give up on that. I have to believe there's a way to make this happen.
Yeah, I guess, I suppose maybe to lean in on the optimism there's also kind of the case count that we've seen in South Africa. They're rising. You are seeing a dropping off of ICU patients and also the use of ventilators there. And that's also comes at a time when Omicron really fades out the other strains of COVID too. So, I mean, if there is maybe a silver lining here, we are seeing vaccinations rise in the U.S. as maybe more and more people pay attention to maybe the dangers of Omicron. But when you look into the case, outcomes, doesn't necessarily seem like that spike in deaths that a lot of people feared last week, at least before vanishing.
So that's a really important point. I mean, what natural infection does and what vaccination does is that both of those protect against serious illness. What they don't do over time is protect against mild illness. So therefore, if you're counting infections, that may still be high, but what you should start to see, and you're starting to see, what you point out, is a separation between infections and serious infections, meaning hospitalizations or deaths. That's what we would expect over time. I think we expect way too much when we're trying to prevent mild illness. We expect that of no other vaccine, no other so-called mucosal vaccine like rotavirus, influenza, the whooping cough. Those vaccines are not very good at protecting against mild illness or asymptomatic infection. So I think we've held this vaccine to a much higher standard. We should be reassured by the fact that hospitalizations and deaths are going down. That's what you want to make sure hasn't happened.
Doctor, at what point should that definition of fully vaccinated with these vaccine requirements, at what point should they include boosters?
My personal belief is that if the goal is protection against serious illness, all the data in this country is that these vaccines continue to do that. So, for example, in our hospital where we do mandate a vaccine, we have a 2-dose mandate. Nonetheless, there are other research institutes or hospitals and universities that have a 3-dose mandate. I think this has been very confusing. And I think we have to define what the goal of this vaccine is. If the goal of the vaccine is protection against serious illness, then 2 doses has certainly consistently been enough. We'll make sure that continues to be enough. And so if the goal, however, is to protect against even mild illness, then the 3rd dose becomes a value. But for how long? Because even if you give a booster dose, neutralizing antibodies will fade over time, and then you're talking about another booster dose down the line, which becomes what, a 4-dose mandate? It's just confusing.
Well, speaking of confusing, Dr. Rocker, I want to touch on all of that because we know that, largely speaking, the global view on how to curb this pandemic is really a vaccine plus, is the phrase that I've heard. So when we talk about masking or testing and all of that, making sure that there's enough access for that, we've seen that mandates like the one that just rolled out in Philly, it has been largely pushed back against. People get really all up in arms about it. So I just wonder, have we, 2 years into this, really found any effective way to communicate properly and also ensure that people are taking the right steps?
Right. Well, certainly I'm in Philadelphia, so the mandates, I think it's the right thing to do. We're certainly doing it in Europe with some success, but there's always going to be pushback. I think in many ways we could do a better job at dramatizing this infection. When I was in service last week, in some ways, I wish I could have shown you what I saw. I mean, what I saw was children struggling to breathe on 3 liters of face mask oxygen and 9 liters, still having low oxygen in their bloodstream, being wheeled up to the intensive care unit, with sedated, put a tube down into a windpipe, attaching it to a ventilator. You see parents crying, and no one's vaccinated. it's just really frustrating. And I think we're in some ways numbed by the statistics. 750,000 deaths. Millions and millions of cases. There's an old awful quote from Stalin, which is one death is a tragedy and a million deaths is a statistic. I think we're sort of numbing people with statistics. I think we have to find a way, and the media can do this, to make this much more real. Honestly, if people saw what I saw last week, I can't believe anybody would then still choose not to vaccinate themselves.
Yeah, Dr. Lester, just to follow up too on that, I mean, you're talking about things that are very visible and things that have been documented, but maybe not as closely as people in your position have seen. When we talk about the other things that maybe are hard to document, we're hearing a lot of reports about long COVID and patients who have symptoms that manifest and stay in the body for quite some time. I mean, that seems rather difficult to kind of put into context of how big of a problem that could be when you think about how many cases, so you might have people escaping death. If it becomes a problem for a lot of the people who have already got COVID, I mean, what are you hearing on that front? Maybe how big of an issue it could become?
Well, it certainly does happen, and it does happen in children. I do think that's more likely to occur with someone who has a mild or severe illness and less likely to occur with someone who has a mild or asymptomatic illness. So again, I think the focus on prevention with this disease should be in preventing, moderate to severe illness, which these vaccines do, and do it 2 doses. So I think, but you're right. I think that is another thing that can be dramatized to make it clear for why it's so important to vaccinate. As Rochelle Lewinsky said, we're not going to boost our way out of this pandemic. And we're going to have to find a way to vaccinate the unvaccinated. We can't give up on it.
A good reminder there, Dr. Paul Offit, Vaccine Education Center Director of Children's Hospital of Philadelphia, attending physician in the Division of Infectious Diseases. Good to have you on today, and our thanks to Angelique Kamani as well. Coming up, Apple shares pulling back even as the tech giant edges closer to a major milestone. Will it be the first to reach the $3 trillion club? Bob O'Donnell from Technologist Research is going to be joining us after the break. Welcome back to Yahoo Finance Live. Shares of Apple pulling back in the session right now, down about 8 tenth of a percent, even as the tech company inches closer to that record $3 trillion market cap. 182.85 is the magic number we are looking for. If Apple reaches that number, it would be the first company to hit that $3 trillion market cap. Let's bring in Bob O'Donnell, Technologist Research President and Chief Analyst. And of course, naturally, Bob, when we're talking about this, Apple shares start to pull back. But talk to me about where you see the company right now. Yes, this is a symbolic milestone if in fact it reaches that, but how much more runway is there?
Well, Kiko, I think there's a fair bit to go. I mean, it's interesting because, Apple themselves recently said, hey, iPhone 13 may not be quite as big, well, I should say, but all the suppliers were saying, hey, Apple told us we're not going to quite sell as many as they expected, and then there were concerns about that, but they disappeared right away. And then we see people talking about a cheaper version of an iPhone SE with 5G and some other things that could drive it. The bottom line is Apple has reached the point that it has because of the ecosystem that's built up and all the pieces that it's put together. And even things that some people, and I'll admit I was one of them, that they weren't convinced was really going to make a big difference. Things like Apple TV, which is still kind of finding its legs, but doing, I think, better than I certainly expected probably would. And lots of other pieces have really come together very nicely. And I think what a number of people and investors are thinking about is, hey, if they move to the glasses, the AR and VR glasses that a lot of people expect to see in 22, that's another opportunity to really build on this incredible ecosystem of device owners and iOS and macOS holders that, really love their devices. And it adds to the repertoire of things they can have and use and that Apple can build applications and services for. And so I think, in my mind, that's sort of that next interesting near-term opportunity that investors are probably thinking about. The question then is, what happens next? Now, mind you, people have asked that question for 10 years, right? Ever since, frankly, Tim Cook took over. I don't know, he doesn't necessarily have the vision and blah, blah, blah. I mean, how many times have we heard that story, right? And here we are, about to hit this, huge benchmark number. Like you said, hey, it's a number, but it says something about the resilience of this company, the ability of it to continue to drive meaningful innovation that people want to take advantage of. And I think, like I said, I think those AR/VR glasses could be the next step.
And Bob, I guess more short term too, you have a lot of analysts coming out maybe raising price targets. JP Morgan, one of the latest here, raising its price target to 210 share from 180. And a lot of it, I guess, stems from what we're talking about there on the iPhone 13 product cycle and how, there was a lot of weakness to do with the suppliers there. But maybe some of that being underappreciated when it comes to a holiday cycle, maybe upgrading their floor presence. I'm not sure if anyone's going to get enough there. But I mean, if that is maybe a boost here, how confident are you that maybe that's turning around because it had looked weak up until this point?
Well, the interesting thing, Zach, is holiday has traditionally been an enormous quarter for Apple. And every year, they surpass people's expectations. And even in the past, we've heard warnings in previous years, by the way. Let's not forget that around holiday time. That I don't know, may not be quite big as yet, then they end up delivering, and typically even over delivering. We'll see this time. I do think there is some pent-up demand on iPhone or the smartphones in general. And of course, that means the iPhone here in the US, because when people were at home during the pandemic, they didn't necessarily feel as, if they needed to use their phone as much, that maybe allowed them to keep a little bit longer life out of it. As people start to move out and about, as people start to travel, a little bit of business travel, vacation travel, I think people are starting to recognize, hey, maybe it is time. And, they're hearing some noise about 5G. They haven't upgraded. A lot of people still, keep 10s and 11s that are not 5G compatible. They're thinking about that. So I do think we're going to see some of those incremental gains. And then, like I said, I think really interesting in 22 is as we move beyond the phones to something different.
Bob, there's a number of things that are outside of Apple's control, though. Think about its exposure to the Chinese market, for example. There's the chip supply issue, but also just the geopolitical risk with Apple having such a significant presence there. How do you calculate that when you think about the growth opportunities, but the potential headwinds for Apple?
Kiko, that's a great point. And I think that is a really serious issue for Apple because they have done significantly better than most U.S.-based brands in China, and they've avoided a lot of concerns and issues that we've seen. But, like you said, that geopolitical situation is getting worse all the time, and the U.S. continues to crack down on the Chinese companies. The Chinese are cracking down on themselves for that. So it's very interesting, of course, to see what that means for Apple. I mean, we saw this more recently about supposedly some kind of big payment that Apple made or took arranged to make sure that they had a presence in China. We'll see how long that kind of success can continue. And unfortunately, it's almost impossible to calculate something around the value of that or not because it changes so rapidly. So it's hard to say. It would certainly be a big hit to Apple and its valuation if there was some dramatic and sudden change in China, which, again, is hard to say. The fact that they made it this far is a great sign, but again, we see lots of changes happening to the Chinese tech companies being driven by the central government, and Apple is sort of that penultimate, U.S. successful story in technology, and it might be symbolically important for China to do something. I would certainly hope not, and I don't think so. I don't think we should necessarily plan, but that is sort of something in the back of younger people's minds.
Yeah, there's a lot to follow, especially as you point out, there on the Chinese side, even among their own companies, and it's kind of harder to predict what happens between the U.S. and China there. But when you look at maybe for Apple, you're talking a lot about the VR, AR headsets, that opportunity. Of course, Facebook really leaned into that space. I mean, how do you kind of gauge the competition there? If it's a big market that's totally switched on, and maybe people have been asleep on, it might not matter as much. But how do you see Apple going up against Facebook?
No, it's, the question, Zach, is how does Apple take something that's been out there actually for several years, but really has been sort of a tech enthusiast type of very specific category, and turn it mainstream? This is what Apple excels at, is they'll take ideas. Remember, smartphones were around for several years before the iPhone. We've seen Apple do this numerous times over. So can they take that concept, it is certainly very intriguing, has a lot of interesting potential, and make it mainstream? And that's where they would differentiate themselves, because I think if you look at the Oculus products and other things that Facebook has, while tech enthusiasts love them, they have yet to make the jump to the mainstream. And that's would be the difference that Apple will have to make. Figure out, applications, usability, how you interact with it, that makes it feel a little bit more natural. And it's often subtle changes that make that difference, and I think that's where people think Apple could potentially do something dramatically different. We'll see. It remains a big question, and of course, it's really would be the first major category that we would see Apple get into in quite some time, and that's why I think there's a lot riding on it, and a lot of speculation as to what's going to happen and what they're going to do.
And that's kind of been the MO of Apple. And they're always first to the market, but they find a way to dominate the market with the product themselves. We'll see if that's the case with AR VR as well. Bob, always good to talk to you. Bob O'Donnell, Analysis Research President and Chief Economist. Coming up, Israel's Prime Minister makes history in the UAE as he meets with Abu Dhabi's Crown Prince. Plus, a frantic search for survivors in the Baltic Sea as two cargo ships collide. That's coming up in our worldview after this break. In a worldview today, a historic meeting in the United Arab Emirates. Israeli Prime Minister Naftali Bennett met with Abu Dhabi's Crown Prince Sheikh Mohammed bin Zayed Al Nahyan. The visit marks the first by an Israeli leader and comes 15 months after the two countries signed an agreement at the White House to normalize relations. Both sides have shared concerns about Iran's nuclear activity, though neither leader mentioned the country by name in this meeting. It is worth mentioning the Israelis were not even allowed to enter the UAE just a few years ago. So our control there. Two people are missing in the Baltic Sea after a British cargo ship collided with a Danish vessel over sailing off the island of Bornholm early this morning when they crashed into each other in heavy fog. At least 9 boats and a helicopter are combing the waters for any sign of missing crew members. The temperatures near freezing, rescuers say it's unlikely they can survive for much longer. Sweden's Coast Guard launched a criminal investigation into the accident, including potential intoxication. Over in Hong Kong, 8 pro-democracy activists who were sentenced to up to 14 months in prison for taking part in a vigil are honoring the victims of the Tiananmen Square massacre. Among those sentenced, media tycoon Jimmy Lai, who is already serving time for his involvement in Hong Kong's pro-democracy protests. The city has hosted the largest Jewish work gathering in the world for years, but it was banned last year as part of China's crackdown on dissent. The lawmakers officially cited the pandemic as the reason for the cancellation. 16 other activists have already been sentenced to up to 10 months in prison for their role in organizing the vigils. Coming up, SEC Chair Gary Gensler looking to tighten the screws on SPACs, calling for more transparency for investors. Does that derail the SPAC boom? We'll be discussing that after this break.
We need to make sure that investors in SPACs are being protected. Look, you as an investor get to decide about where to put your money. But companies raising money from the public have to provide adequate disclosures. I think we can enhance the disclosures of companies raising money via SPACs. I've asked staff for recommendations about how we might update our rules so that investors are better informed about the fees, the costs, the conflicts that may exist in SPACs.
That was S&C Chair Gary Gensler last week warning about the risks of special purpose acquisitions for SPACs, calling for increased oversight over those transactions. It's been a banner year for SPACs so far with a record 83 SPACs raising more than $30 billion in Q3 alone, according to Reddit. Let's bring in Jacob Frankel, Dickinson Wright Government Investigations and Securities Enforcement Practice Chair. Jacob, I know you've been on the other side before, looking at potential regulation. When you see how some of these SPAC transactions are carried out, what do you think is the most significant risk, and how should the SEC be handled?
Well, that's a great question. I think the critical point is that Chairman Gensler indicated that he's had to staff the proposals. And the areas in which we have requested staff proposals as to change the rules are to address disclosure, marketing practices, liability for sponsors, engagement. I think we also have to look at what we've seen in terms of the SEC recent cases, as well as what are the issues that have arisen in the recent investigations, to give us some idea as to where they might go. And it also comes back to the fundamental issue of disclosure. I mean, right now we have SPACs are able to make revenue profit checks. They're able to avail themselves of the safe harbor and forward-looking statements, which is not necessarily true within the public offering. So there's a fundamental concern there of what are the projections on marketing. I think that's one area where we're likely to see some recognition. The other is the little impact on the shareholders. I think when we're talking about dilution, that goes back to any word, disclosure. And I think the other area is the sort of conflict of interest. When we're talking about compensation incentives, the original sponsors, objectivity in the acquisition target, what other businesses are members of the board, officers, essentially involved in. I think all of these areas are fair game, but ultimately, I think it's a matter of, it's a function of disclosure, enhancing disclosure, and trying to level the playing field in more of the traditional public office.
Yeah, and obviously, I mean, there are a lot of good reasons as to why some of this stuff might be needed, particularly when you look at maybe some of the examples from this year in terms of what investors have gotten when it comes to details. I point to the Trump attack, the social media company, and Digital World Acquisition Report. That caught a lot of attention as its SPAC, went out and kind of put out only slight details around what that would even look like and who's going to be there in key positions. I mean, when it comes to how investors are, SPACs are up more than 400% though on the year. When it comes to investors and how it differs from IPOs, I guess one of the things you want to see change most quickly when it comes to this three that you kind of laid out there.
Well, yeah, I think it really will revolve around the scope. I think that's fundamentally what we're going to see. I think there's some different issues in the U.S. SPAC. And I think there's some who view that as a function of, well, President Trump's involved. I don't view that as the issue at all. I think the fundamental issue there is whether there were pre-merger discussions that were not disclosed. That's always been an issue when it comes to SPACs. I don't think we're likely to see any rule changes, not really, in that area specifically. Let's also not lose sight of the fact that back in December 2020, so when we were talking about the President Clinton administration for the SEC's Division of Corporation Finance issued guidance regarding concerns, conflicts, other issues with respect to SPACs. Back in April of this year, I believe it was in April, the Commission issued a release requiring most warrants issued by SPACs to be accounted for liability. We're already seeing the tightening in various areas, but I think it's really going to focus on leveling the playing field in the area of disclosures.
I wonder how you look at some of these EVs that have come to market through SPACs, whether it is Lucid, now under SEC investigation, as well as Nikola, which is under investigation for different reasons. I mean, how many of those companies do you think could actually have gone public through the traditional IPO route? Now that we know some of the sources like their balance sheet, as well as the fact that they didn't necessarily have a product in the pipeline.
Well, I mean, again, your point about having a product in the pipeline, I believe the stat on Rico, for example, it has a multiple valuation and gets to be on track. So I think that's a real issue. But I also think that every one of them could have gone public via the initial public offering route. I think the biggest difference is that there would have been much greater scrutiny because the SEC's Division of Corporation Finance likely would have had a lot of issues that would have put on the table in the comment process. There would have been stricter governance or guidance implicating and impacting the projections. And you would have been looking at, the investors would have been looking at the company itself, not the status. So to your question, because I think every one of them could have gone public still via the IPO route, but there's no way, in my opinion, they would have achieved the same valuation they achieved by having gone public via the SPAC route. And additionally, I think there would have been greater scrutiny of all the disclosures.
Jacob Frankel, Dickinson, right, government investigations and security enforcement practice share. Good to have you on today. I always appreciate you today. Coming up, President Biden looking to close the deal on that bill that but getting to win over a key senator in time for Christmas. We'll discuss that after the break. It is a pivotal week in Washington as President Biden looks to pass that near $2 trillion social and climate spending package by the Christmas break. But he's still got one key holdout in his party. So what does he need to do President Palmer, let's bring in Yahoo Finance's Rick Newman. Obviously we're talking about Senator Manchin here. CNN reporting, Rick, that the president did in fact have a conversation with the senator last week. He says he's not fully on board just yet. What do you think of this one? He's just waiting.
Nobody knows. That's what was so infuriating to those Democrats about this. Manchin has said what he doesn't like about this legislation. He thought the original price tag was too high, so it has come down. It's now around $2 trillion, perhaps a little bit less than $2 trillion. He's worried that it's going to generate additional inflation, but he hasn't said how you might fix the bill to address that concern. So Manchin has been enigmatic on this legislation all along, to say the least. And I think what most Democrats want is for Manchin to put up a shut up to say, I'm going to put this bill on the whole thing. I think Democrats are reasonably optimistic that somehow Manchin does have a plan for how he will actually sign off on this legislation. He just hasn't shared it. So that's what Washington is waiting to hear. Everything hangs on this one guy at the moment.
And Rick, can you talk specifically about the urgency, the timing of all this? We've only got a few weeks left in the year, but the president's certainly looking to close the deal now because next year the focus is going to be really on midterms.
Right. The urgency mostly is political. There's nothing that says this legislation has to pass by the end of 2021 or it's dead. But I think that what Democrats want to do is they want to get this done in 2021 so they can sort of start fresh next year and they don't have this lingering. They also like the idea of a deadline. I mean, if they set a deadline, that is one way that Congress actually gets self-confidence to come right up to a deadline and often it's the 11th hour right to the deadline. There is one practical element to this, which is that expanded child tax credit where millions of families are getting extra money in the bank. That actually expires in December. So in order for that to continue, this would have to be approved again if the legislation doesn't include only the extension of that. So that would have to occur by late December. But on the other hand, if it does drift into January or even February, which is very possible, Congress will also always make those child tax credit payments in January and February retroactive so that they would pop up in people's bank accounts anyway. So mostly this desire to get this over with after, I don't know, what is it, 8 or 9 months they've been developing this legislation, talking about it, so they can move on to an election year in 2022.
Yeah, it looks like there was a lot of unity when Trump was in power when it came to Democrats, but this year has proven out that there's still a lot of things to get agreement on. Another year going by, Democrats can't get marijuana reform done either. That's something that a lot of people were hoping for. Rick Newman bringing us the latest there on that front. Appreciate it. Coming up, let's get non-political for a change here. Then, of course, the body that's not supposed to be political. Of course, a very busy week for Jay Powell and Keith Sessions Mike on Wednesday. Key decision around rates. Their timeline looks like as the unwind their asset purchases. We'll have the details there on the other side. Stay with us. Welcome in to Yahoo Finance Live as we cross the noon Eastern Time trading hour. I'm Zach Booth on alongside Ikiko Fujita. Happy Monday, everybody. In today's session, we do have markets accelerating their move to the downside as the Dow is off now more than 250 points. The Nasdaq, as you can see there, leading the way lower off 1.33%. Plus, the Senate back with a crypto hearing of their own following a big testimony in the House with crypto leaders. Alan's Washington Insider is going to join us to explain what to watch for in that as Bitcoin sinks even lower than hitting more than 2-month low, off by about 5% today. The climate change activists coming back for ExxonMobil. The one activist group won 3 new board seats for the company. Another is pushing for a steeper cut to carbon emissions. The founder of activist group All of This will join us on what they want to see change. But first, the Fed ending the year with the last policy meeting of 2021 and a lot of pressure on Fed Chair Jerome Powell after recently highlighted that the agency might be moving off its asset purchases quicker than expected. More rate hikes expected now next year in 2022 as well. More on that. Our Fed reporter here, Brian Chung, kicks us off in the new hour. And Brian, I mean, when we look at it, obviously, it's been a pretty rapid change of tone, I guess, due to the transition and now allowing the bond market pricing in 3 rate hikes for next year. But what are you expecting to hear when Jerome Powell addresses investors?
Yeah, well, certainly it seems like the markets might be getting ahead of the Federal Reserve announcement. We're going to see that expected on Wednesday afternoon for a possible speedier tapering process. Again, the Federal Reserve had already announced in its early November meeting that it was going to begin the process of slowing down its asset purchase program, hoping to bring the purchases of U.S. Treasuries and agency mortgage-backed securities to a full stop by the middle of next year. If the Fed follows through on its commentary in recent weeks to speed that up, they can wrap that process up by the first quarter of next year. Now, why that? Well, because that means that the Fed might have more flexibility and optionality to then earlier and perhaps more aggressively eventually raise interest rates again than will be that at near zero. Now, again, the Federal Reserve hasn't made that announcement yet, but it seems that markets are trying to fight this convention and taking a look at rates on the longer end of the curve, especially in some of the movement, especially anticipation of more possible rate hikes in 2022. Now, all this is also happening on a global scale as well, because it's not just the Fed that's going to announce their policy decision this week. Consider that Wednesday, the Fed's going to go first, and then on Thursday, we'll also hear from the European Central Bank and the Bank of England, and then on Friday from the Bank of Japan regarding how they're approaching very similar dynamics at play as well. The labor market that's going to respond with inflationary pressures that are rising, especially with the supply chain issues that have really dogged down on all of the global supply. So that's definitely going to be a rough scheme as other banks will tighten as well. As Bank of England, for example, Governor Andrew Bailey has mentioned prior to the Omicron variant that he may have been in favor of an earlier rate hike in their jurisdiction, but perhaps that may have been off that since the Omicron variant emerged. So a lot of different factors at play here, which should make this holiday season a bit more special for the central bankers than I'm sure they had anticipated headed into the end of this year.
All right, Brian, trying to bring this latest there. Of course, we'll be watching that with live coverage here this week to get that policy announcement. I want to turn to what it all means here as we are, of course, bracing for that decision, what it means for the markets. Investors try and figure out where Jay Powell and the Fed might go from here. For more on that, I want to bring on our next guest, Chester Spath, is professor of finance at Carnegie Mellon University's Tepper School of Business. And Professor, thanks for coming back on here with us. I mean, we're looking at maybe this decision. Obviously, the Fed has moved a lot quicker here to quell inflation rising at the fastest rate we've seen in decades. I mean, when you look at that, how much of it is maybe just tied to the situation around COVID? And what are you expecting to hear from Jay Powell next month?
Well, I think that I think a lot of the current situation is it's tied to the past policy response to the COVID. We've had inflationary pressures over the last year to a dramatic degree. We had pressures on the one hand because of efforts by the government to increase demand.
both efforts of the Fed to heighten liquidity and the efforts of the administration in fiscal policy to replace income that is more than replace income over the last two administrations. And at the same time, we've had a lot of incentives for people not to work. To some extent because of the COVID, and to some extent because of the infusions of government resources which have discouraged people from working. So we have a situation where we have huge demand and reduced supply. So of course we're going to have inflation. I think it's remarkable that it's taken the Fed and the administration so long to recognize it until at the start of the month they coordinated and stopped using the word transitory. But I think I think we're facing a very serious situation. Unemployment is close to record lows, now at 4.2%, and inflation is the highest it's been in 39 years, at 6.8% on an annualized basis. It's a huge problem, and I'm glad to see that there's finally some recognition of this, so that it's going to be on the heels of reducing the purchases of bonds.
And to what extent do you think the Fed's credibility has been hurt as a result?
I think the credibility has been hurt. I think the use of the word transitory has become a joke over the recent months. Now, I think the feeling with the Fed is that if it engages vigorously in the inflation fight and is able to handle the inflation, then its credibility will be restored. That's so we'll have to see what happens. Whether 3 rate hikes next year are going to be sufficient. I think this is very much of an open question. But part of the problem on the inflation side is in part the loose money policies of the Fed, but I think it's also the broader fiscal policies of the administration. To some extent, I think this was sort of justified at the early stages of the COVID, and at some point, we had unemployment rates of more than 10%. Right now, unemployment rate is 12.2%. Yeah, we have lots of jobs. Lots of jobs. We have more than 10 million vacancies in the economy.
Yeah, it's a very good point. I mean, the other thing too that we've been hearing from a lot of people talking about inflation and problems there, maybe louder in the cryptocurrency circles around the dollar and what all this money means to the dollar, has not necessarily come to fruition. We are talking about inflation here, the dollar itself, and how that's pretty strong against global currency, and as Brian highlighted just a little bit ago. There are key decisions being made by central bankers all across the globe. I mean, when you look into that, maybe how the dollar, even against the yen, doing maybe not with the same inflation pressures we're dealing with here. How do you kind of gauge, I guess, in the global context, how the Fed has managed this situation and where it sits, given the fact that the dollar has held up?
I think the Fed, I think the Fed has been, I think, quite stimulated. I think this has improved to some extent around the globe. Maybe not quite to the same extent. Things started out where interest rates in the U.S. were at higher levels than other countries. So the Fed had the luxury of being able to allow interest rates to decline further and quickly. It's really, I think the issues now are not so much about the initial policy response, but in my view, particularly the response over the last year. And just to be clear, dealing with something like the COVID in the context of monetary policy is certainly challenging. We really don't have historic experience with respect to something like that. But I think the balance between, on the one hand, pushing demand, and on the other hand, some of the natural restrictions on supply, and then policy-induced restrictions on supply by discouraging people from being willing to work. That's a really tough thing.
Carnegie Mellon University professor of finance. Good to have you on the show. I appreciate the time. Well, over the weekend, we saw a former NFL star and Good Morning America host Michael Strahan, who's become just the latest to venture into space for a brief journey.
Mission Control has confirmed New Shepard has cleared the tower and is on its way to space. Touchdown. Alright, that is here all around from the drill. I think it is safe to say that the word touchdown has a new meaning for Michael Strahan today.
And you see the safe landing there. Strahan was among the 6 crew members aboard the Blue Origin rocket. He was joined by the daughter of famed astronaut Alan Shepard, who, by the way, is what Blue Origin's New Shepard is named after. Strahan almost immediately after returning, he launched the boy back. This was the 3rd Blue Origin flight and the first full flight with all 50 on board the capsule filled. Yeah, never gets old. I love watching it.
A lot of progress being made there. One of the high-profile celebrity entities on the Strahan, of course, too. We'll see who else they fire up into space. Of course, we get to that. Elon Musk, first of the year, he's got that up there. So that battle continues. I'm going to take another quick break here on the show. When we're turning deeper into crypto, and we see the weakness continue to accelerate for Bitcoin and the like, off close to about 5% today, ahead of a key Senate banking hearing around stablecoins tomorrow. We'll chat with Alan on the other side about what to watch for stablecoins.
Going back to Yahoo Finance Lab, today's crypto corner, we are watching crypto prices slide back a bit. Bitcoin reaching a more than 2-month low here as it moves back below that $48,000 level. Of course, all these were coming on the heels of what we saw last week in the House Financial Services Committee hearing featuring some pretty big name executives in the crypto space, and the Senate coming back with a hearing of their own focused on stable coins. We're going to get that in the Senate Banking Committee. And for more on what to watch there, I want to bring on Garrett Seaver, Callan Washington Research Group Managing Director of Financial Services and Housing Policy Analyst joining us here. And Garrett, we look at it, obviously regulators have been keenly focused on stable coins as a kind of, I guess the main question we heard in the House Financial Services Committee was the threat to the U.S. dollar and what it means for the global reserve currency status the dollar enjoys. What are you expecting to hear this time around as maybe it might not be as friendly as that House hearing?
Yeah, it's going to be a lot more contentious. I mean, the House hearings, there were a lot of witnesses, there were a lot of members, it went on for 5 hours. Senate banking is going to be much more concise. You have 2 crypto critics who are testifying, and I expect a lot of punches to be thrown.
I mean, you specifically pointed out the banking chair, Senator Sherrod Brown. It's sort of a risk thing. It really depends on how aggressively he's going to move on that. Can you lay that out for me? Why do you see that as a risk, and what are they?
Sure. So, I mean, the Senate is really all that matters when it comes to legislating. And I mean that with no offense to my friends in the House, but at the end of the day, the cliche in the House is the Senate is where legislation goes to die. And the House can pass as many crypto-related bills as it wants, but if Sherrod Brown doesn't become a champion of crypto legislation, it's simply not going to become law. And so how engaged he is in the subject, how much he really wants to help financial regulators clarify the law, it's really going to matter. And this is our best indicator that we've had in the last 12 months as to what he's going to do.
I guess maybe we heard some of that frustration from the executives in the House hearing last week, mainly when you think about Brian Brooks. You got a lot of airtime speaking in front of congressmen and women there, CEO of mining company Bitfury, but he voiced maybe some of the frustration there in action in Congress. Just want to play what he said. Take a look.
Is it consistent to take the position that only banks should be allowed to issue stablecoins, but then fail to grant bank charters to the largest issuers of stablecoins? Does it make sense to bring enforcement actions challenging certain crypto assets as unregistered securities, but then fail to allow those assets to be registered and trade on a national securities exchange?
Yeah, let me turn maybe the question on its head here and talk about how it could be a positive if it's so hard to get things changed in Congress, because some people in the crypto community say, look, these things are going okay. Maybe it'd be better if we have some clarity around some of this stuff. But outside of maybe more regulatory pressure that messes things up as they're going, maybe steady as she goes is fine for some of these companies.
Okay, so, this is always the question, right? Because you have a lot of risk whenever Congress tries to wade into something, particularly as complicated as crypto. I mean, let's face it, if you were to poll, all 535 members, who knows really what the knowledge level would be on the House, up on Capitol Hill. By contrast, we do have more confidence in the regulators. The problem is that the regulators basically are carte blanche right now. And, as you heard from former acting comptroller Brooks, there's a lot of frustration with the SEC. There's a lot of frustration with banking regulators. At the end of the day, if we were to just get some small clarification, I really think it could go a long way to providing the clarity that the industry really seeks.
How optimistic are you that we're actually going to get that in these congressional hearings, and what should that look like? If you're not talking specifically about regulation, but a little more clarity that gives guidance, what should that look like?
Sure. So I think the most important thing in the short term is stablecoin. It is we've seen before before with money market mutual funds, which I think are the closest analogy, that in times of crisis, you can have real liquidity problems with money market mutual funds. We saw that at the start of COVID-19. We saw that during the great financial crisis. Some of my friends at the banking agencies like to go back to prior to the FDIC, when you had private banks without deposit insurance, and similarly, you have liquidity risk and run risk. And I think that, as stablecoins become part of the broader economy, they get used for more things, as they become more of a payment mechanism and less of a way to trade Bitcoin and other cryptocurrencies, you really need that stability. And so I think some clarity as to exactly how those liquidity rules would apply could be really helpful to this sector.
Sure, I guess lastly too, some people were optimistic and really came away with a positive attitude off that House hearing because it was a lot of questions and answer seeking rather than talking tough. Some congressmen and women there seemed like a genuine interest in learning more. I mean, Senate banking might actually have a better stronghold in some of these issues, particularly when it comes to stablecoins. But what is your expectation maybe for this one and what it might mean for, I guess, a warming of relations between regulators and crypto?
Yeah, all right. So I'm not very optimistic on that front. I mean, I think that, to be honest, Gary Gensler has pretty firm views about the crypto industry. I mean, we've heard how many times that you say, clean up in aisle 3, and his other things, comparing it to the Wild West or casino checks. I mean, all these really bad analogies. And so, I think we are going to see the SEC continue to be an impediment really to the crypto space. But that may be okay in the short term, right? I mean, we really do need regulation to catch up. We do need clarity on stable coins to catch up. Our overall message is still really positive. We are past the point of Washington talking about getting rid of crypto. This is an industry that is here to stay. It's going to grow. I just think we're going to have a couple of years of chaos in Washington that just needs to get sorted out.
Here in Seabird, Alan Washington, research for Managing Director, bringing us latest there. We'll be on watch tomorrow for that Senate banking hearing. Appreciate it. Going to take another quick break here on the show, but when we return, ExxonMobil once again landing in the crosshairs for activist investors after we got 3 new board seats. There's another activist group out there looking for a super cut to that company's carbon emissions. That was the founder of that activist group. All this on the other side of the break. Welcome back to Yahoo Finance Live. As we've been watching the scenes play out around climate activists and some of those big energy companies, now ExxonMobil, the latest target for climate activist group Follow This, the group filing a new shareholder climate resolution for Exxon, urging the company to publish its medium and long-term carbon emissions targets ahead of its 2022 general meeting. Follow This is also targeting Marathon Petroleum. During this round of discussion filing is Mark Ball, Follow This founder. Right now, Mark, I appreciate you taking time here. I mean, we've talked a lot about maybe some of the activists pressuring ExxonMobil. Of course, they had that big battle. We saw another activist group get 3 new board seats at Exxon. Talking about what this push is particularly about and what you want to see change that.
We just put a very fair ask on the agenda, and we asked ExxonMobil, like we asked every oil major when we filed climate resolution, commits to Paris climate to decrease emissions in line with the Paris Climate Agreement, which means approximately halving emissions in the next decade.
I mean, is it as simple as that? ExxonMobil was counter-rated. We put out our own plan, which includes the carbon capture. It sounds like you're looking for not just a reduction of direct emissions, but indirect or scope 3 emissions. Can you talk about that a bit more?
Yeah, exactly. Yeah, thanks for asking that. The emissions of the products of oil majors are the elephant where nobody likes to talk about. But that's 90% of their emissions. So every oil major needs to set emission reduction targets for all their emissions, not only their operational emissions, but far more importantly, the emissions from their products. And if they would do so, they have to conclude that they have to invest completely different in the next years. Because they can't grow in oil and gas anymore, they have to invest in renewables. And that's where we come from. All of this is basically based on the conviction that we need big oil to have any chance to meet the Paris climate goals, to have any chance to stop climate change. Big oil can make or break the Paris climate accord, and they need their shareholders to support them, and if needed, to push them to commit to the Paris climate agreement and start investing differently. That's the only way we have any chance to fight climate change.
When you talk about these indirect emissions, this is something that so many companies have had to deal with. It is more than a majority of the emissions that a lot of these companies account for. It's in their suppliers, it's down the chain. What are you looking at from a cost perspective for Exxon? What kind of undertaking would that require on the part of this company?
Yeah, scope 3 emissions can be quite complicated for most companies, very difficult to estimate what the emissions are when your customers use your product. Say you're a car producer, you produce another product. But for all majors, it's quite simple. We know that every barrel of oil that's been sold will be burned and will cause CO2 emissions. So scope 3, product emissions is very simple to measure. And we also know that the scope 3 emissions, all emissions have to halve in the next decade to meet the Paris Agreement. And so that's what everybody has to work on. So on the demand side, we have to make different choices, but on the supply side, the energy industry, which is now also fuel industry, should completely overhaul the supply of energy. And yeah, the only way to achieve that is to stop investing in exploration of more oil and gas, and then start the exploration of new visible renewables. Renewables are getting cheaper by the day. The world is not asking for oil and gas, the world is asking for energy, and preferably renewable energy. And we need big oil, they have the brains and abilities to achieve the Paris Accord to make sure we win the fight against climate change.
Look, I mean, I guess, when we talk about these resolutions, obviously used them for other big energy companies too. That Shell, we talked to you in the past about that push. I mean, talk to me about how important this avenue is rather than maybe some other avenues you could take to really impact carbon emissions and whether or not you've seen the success that you wanted to so far by going this path.
Yeah, with Shell when we started in 2016, and later with BP, Equinor in Europe, and Chevron in the US. We've seen the exact same pattern all over every time again, and that's you file a resolution, the company says you're asking for emission reduction of scope 3, that's not our responsibility, you don't know what our customers do with our product. So you're asking something unreasonable. So the shareholders please vote against the resolution. Then more and more investors started voting for these kind of resolutions. With Chevron, for example, last year, 61%. With Phillips 66, even 80%, 80. And then these companies set a scope 3 target. In the far future, in 2050, not enough to reach the Paris Climate Agreement. But with these kind of resolutions, climate resolutions, we've proven that all majors only reluctantly take steps in the fight against climate change when their shareholders are voting for these kind of resolutions. So far, that's the only thing that has worked.
And on that front, something that Zach mentioned earlier, engine number one earlier this year successfully winning 3 new board seats on ExxonMobil's board. The idea here was to push the oil giant to move more aggressively in cutting emissions and accelerate that transition to clean energy. Have you seen the results?
Not with Exxon yet. These board members are just a couple of months in their position, but we really think that our resolutions and the actions of engine number one, getting board seats, will enforce themselves. They are inside. We are now inside with climate resolution. We have rearranged the push from shareholders. So at the end of the day, this will enforce each other. For a start, Exxon cannot unanimously reject our resolution like Shell always does.
The progress, obviously takes a lot of effort. Appreciate you coming on here to chat with us about some of the pushes, much of all, follow this founder. Appreciate your time. Thanks again. Coming up, get ready to throw that suit back on. Weddings are expected to hit a record number next year, and TikTok star Your Rich GFF, speaking with young financial planning, talking about the best ways to budget as a wedding guest. Great to have you.
Yahoo Finance, I am Brian. So, the pandemic has pushed a lot of weddings into next year, and wedding booking planning websites have not now said there's estimated 10.6 million weddings that will take place in 2022. That would be a record high. So, the cost associated with attending a wedding could be pretty burdensome, and that's actually the subject of financial literacy theater and TikTok star Vivian Tu, aka Your Rich BFF. Recent post. So Vivian, good to have you on the program this afternoon. And we faced a lot of these types of situations before, right? Kind of someone you know that you're not that close to. So no disrespect if you're not necessarily willing to shell out that kind of money or can afford to shell out that kind of money to go to a wedding. What do you do in a situation like that?
Yeah, I think honesty is the best policy here. I have a general principle that I love to share. You tell them that you're honored to be their bridesmaid, their groomsmen, but you need to be really transparent about the fact that you have your own financial goals, such as paying off your credit card bill, or saving for a down payment on the home. And what you can share is that my budget is XYZ, so I want to hold back your vision for your special day. So it's completely okay if I come as a guest, and I'm happy to support you in a multitude of other ways. Because being a guest at a wedding these days can cost $440, and if you're traveling, it's closer to $1,440. So it's very, very pricey and can add up very quickly.
So Vivian, what are the added costs that are associated with actually being part of the party, right? If you're going to a bachelor's party or you're going to a bachelorette party, you should expect to spend a lot more money than if you were just going to the wedding itself, obviously depending on whatever activity it is that you're doing at the bachelor or the bachelorette party. How does that factor into the decision too? Because if you're asked to be part of the party, that's a really big thing to say no to, right?
Yeah, it definitely is. But I think when we all think about wedding spending, we're like, okay, well, flight, the hotel, and I gotta be there on time. But I think we often forget that for some of the gentlemen, you've got to rent a tuxedo or a suit. And for the ladies, you have to buy a bridesmaid's dress. You might have shoes that you need to buy. You're gonna wanna get your nails done ahead of time. Hair and makeup, that all costs money. And then bachelor and bachelorette parties, especially with the rise of social media and FOMO, have gotten grander and grander. And very quickly we're renting a yacht and partying in Cabo, and very quickly there are costs to food, to shelter, to entertainment, to activities, excursions, and they all just add up.
So Vivian, I mean, how awkward of a conversation can it kind of be though if you have decided you want to have that conversation with someone that you won't be able to attend their wedding? Because obviously, it is a tough thing to say no to, and especially if it's someone's really important day, that might be a little bit awkward. Now, obviously right now, a lot of these weddings are happening because of the pandemic. Might it just be better just to lean on, well, I just kind of don't feel safe going to a big gathering right now, and just kind of maybe going down that route?
Yeah, if you're feeling awkward, you're 100% not alone. 33% of people actually, based on a 2019 Credit Karma survey, said that they wouldn't feel comfortable declining even if they could not afford to attend. But yes, right now it is a great time to be able to lean on COVID, lean on restrictions, and just say, hey, this is not something I'm currently comfortable with. But I truly do believe if the person whose wedding you're attending is your good friend and you are totally honest with them and really share how you're feeling, they should accept that.
And then lastly here, talk about gifts here, right? Obviously, when it comes to if you are attending the wedding, you've chosen to attend the wedding, what kind of advice do you have in terms of should you just give cash, should you give a gift card, should you buy something that you're not sure they might need, just going with the wedding registry? What do you think are the kind of best opportunities and options to go with?
Yeah, I think a lot of more modern day couples these days are actually creating cash funds, which is so wonderful because you can give as much as you're comfortable. Typically, I generally consider the location, the wedding costs for them, and try to cover what I would assume would be the cost of my plate. That said, if you aren't comfortable with that, check out the wedding registry. There's oftentimes items that are going to be more affordable for younger attendees, items that are quite a bit more expensive for closer family and friends. So there is a lot of room to negotiate and keep within your budget.
All right, pay your plate. Good reminder right there. Vivian Tu, financial literacy creator, and you can find her on TikTok at Your Rich BFF. Vivian, thanks again for stopping by. One more market coverage of everything going on, including that big meme stock sell-off on the other side of the screen. Welcome back to Yahoo Finance Live. We're seeing major indices bounce off just slightly over their lows. The Nasdaq now off less than 1%. We are seeing a mixed day when it comes to the sectors right now. Consumer discretionary and energy, two biggest laggers. And for more on all the moves, when I get to Yahoo Finance's chart master, Jared Flickery, who's been watching that for us. Jared.
That's right. We got 3 full weeks left of trading and no more. And this is typically the time of year that we do kind of see the Santa Claus rally kick off into high gear. Although officially it's only the last 5 days, 5 trading days of the month in the first few of January. But we're not going to split hairs. So let's get to the Nasdaq 100, where we are seeing a little bit of down action today. One of the standouts is Facebook. That stock is up 1.33%. You can see that at the bottom of your screen. But some of the other standouts first. Let me get to a market cap view because we came within inches of Apple hitting $3 trillion intraday, but not just there quite yet. In fact, we're seeing the majors and the mega caps largely off, and some of the standouts also include Tesla. Now, we've been covering this story because, of course, Elon Musk, named by Time Magazine, its Person of the Year. Lots of comparisons to Amazon, and we can see the stock off about 5% today. But let me get back to Amazon, because in 1999, Jeff Bezos was named the man or the person of the year for Time Magazine. If we put a max chart on, let's see if we can see the price action. Now, it's going to be too small from way back in the day, but there was a roughly 95% drop from the peak to the valley after that call. So that's what everybody's looking at on Twitter today. By the way, the Nasdaq surged another 30% after that call. So it just goes to show that bubbles can persist for some time. So let's take a look at the sector action. It's pretty defensive here. We're seeing real estate, staples, utility, and healthcare. Those are all taking the top spots today. And to the downside, we're seeing consumer discretionary, which houses Amazon, by the way, and energy and financials. Each of those are off 1 to 2.5%, as we can see here. So let's dig into the financial sector. This is the banking sector, where we're seeing negative price action. We saw some surges in this sector over the last few months, but I would say in the last month or two, the value trade really hasn't fallen off. And so we're seeing a continuation of that today. And in the travel sector, wow, a lot of dark red here. Just about everything off of 4 or 5% or even more. And we're seeing that United, that's off more than 5%. So is American Airlines. So is Davis Budget Group. So not a lot of love for the travel sector right there. But there is a little bit of a respite here. Well, there was earlier in the day, not seeing it now, but semiconductors taking on in the chin, as well as things into the red, guys.
And Jared, in the commodity space, remember that big sell-off we saw in oil immediately after that first reported case of the Omicron variant. But it sounds like OPEC is still pretty optimistic about where their demand levels are likely to be Q1 of next year.
That's right, and they've increased their demand forecast for not only this year, but next year, roughly 200,000 barrels. And I'm going to go back to the Wi-Fi Interactive, where I'm going to show a chart of crude oil, basically trading water for the day. We can see it's only up about 7 basis points there, but we've seen some volatility yesterday. We're going to see this when I put a 2-month candlestick chart on, and you can see, Pico, you were talking about that big downdraft on the Omicron news, so that was that day there. And we also saw President Biden releasing strategic petroleum reserves from our stocks in the U.S. and as well as around the world. Nevertheless, it looks like we have a pretty firm trading range, and we're going to see $85 to $75 be really in focus as traders try to navigate here. And Kiko, you also mentioned the Saudi oil minister, some statements today with that OPEC Plus announcement of their demand forecast. Well, they're saying we've reserved the right to dial down our production. We know that they've been increasing at 400,000 barrels per month. However, that could flip on a dime, guys.
All right, Jared Butchery bringing us the latest moves there. Appreciate that. Going to take another quick break here on the show, but coming up, an interesting move by Peloton to play off the Sex and the City reboot that sparked some controversy around their product after a character. I don't want to get into spoilers here. Maybe we'll chat that on the other side here. But Peloton coming out with a very provocative ad, shall we say? We'll break it down on the other side. Stay with us. Welcome back to Yahoo Finance Live. An ad from Peloton has the Twitterverse and the wider media world buzzing after Peloton was implicated, shall we say, in the Sex and the City reboot. One of the characters there, Mr. Big, died of a heart attack after briefly finishing the Peloton ride. And now the company is shooting back with a bit of its fun ad here, the clapback. Take a listen.
To new beginnings.
To new beginnings. You look great.
I feel great. Should we take another ride? Life's too short not to.
And just like that, the world was reminded that regular cycling stimulates and improves your heart, lungs, and circulation, reducing your risk of cardiovascular diseases. Cycling strengthens your heart muscles, lowers resting pulse, and reduces blood fat levels. He's alive.
So there you go, Kiko. Ryan Reynolds having some fun with that one too, as the voiceover there in the produced ad for Peloton. A bit of a funny take on the way that the character, you know, and the company itself and the bike itself was kind of implicated in that character's death.
Zach, my take is that this is all part of a brilliant marketing campaign. I mean, it's possible, right? Peloton has said they turned around this ad in a 24-hour span, because if you think back to what happened on Friday, we saw the stock hit a new low on the back of that, which I'm still surprised by. And for those who are not as familiar with what happened, I think we're allowed to talk about spoilers here, which is that in the Sex and the City reboot, just like that, Mr. Big, the character, died after taking a 45-minute Peloton class of a heart attack. And you saw the instructor there, Jess King, making her cameo in that ad. But I just think it's interesting how on Friday we were talking about this episode. I was one of those that went and actually looked at the end of the episode to see how Peloton was actually, as you put it, implicated. And here we are talking about Peloton again and the ad. So I don't know, were they in on it with HBO Max, you think?
I don't know if they were or not. I think we're both in agreement that, you know, we've seen the underbelly, the ugly underbelly of production, and to do these things quickly and turn around in 24, it seems unlikely just based on how much work goes into some of these things. But at the same time, Akiko, you know, talking about the company is one thing, but just overall, I don't know how much, you know, the Sex and the City reboot Peloton implication had to do with the share price. We saw shares off more than 10% last week in a day. When we're looking at it now, I mean, we back up off by about 70% on the year in the last year. I mean, the company is not going to turn things around with one ad, though it is maybe a step in the right direction, because this is a company that, you know, we talk so much about those pandemic players. I'm not sure where they fall on this in terms of us getting back into the gym and what it means for the company if this one is really going to move the needle in that storyline.
Yeah, it has been struggling largely as more and more people go back out to the gyms, moving away from the home. And of course, it's almost tough to reach the kind of levels that Peloton saw last year at the height of the pandemic. But Dak, I'm curious about the streaming side. How many people actually went to go watch this episode after hearing about it and reading about it? I don't know. I was not a huge Sex and the City fan, so I was never planning to watch that episode. But then I heard about it, and it got me curious. So I'm just curious how many other people actually went and what the numbers were like for HBO Max.
You think a bit of a win-win here. Both sides playing with each other to both win on this one. In the end, I think Peloton did do a good job of kind of capturing some of that. I don't know. I just had my first Peloton not too long ago. I'm not sure what camp you're in, but to me, still just like riding any other stationary bike. I'm not sure what I'm missing here, but really not on that bad way.
It's a lot of money. I don't have the bike. I think the Peloton Classic, which I love. And by the way, it's not a bad deal if we're talking about $14, $15 a month as opposed to going to the gym. So I think a lot of people have been taking it through that as well. But I have yet to try the bike. I think there's a lot of people who are purchasing a cheaper bike and rigging it so you can take the Peloton riding classes alongside it without the cost of a Peloton bike.
That's the kind of personal finance tips we need around here. The way to rig the Peloton thing in 2022. That's
Just
a
put
good
an
look
iPad
ahead.
on there.
That's going to do it for Kiko and myself in our hours here on Yahoo Finance. We'll leave you with that one. And a reminder that we've got our special Retail Revolution coming up at 4:30 p.m. Eastern Time. Of course, we saw the rise in meme stocks, commission-free brokerages, and the retail investor in 2021. Tune in. We're going to take a look
back at the wild year on Wall Street in that special. Of course, much more coming your way right after this.
Some of the nation's largest hospitals dropped their COVID-19 vaccine mandates to ease a labor crunch. That's after a judge halts a Biden administration mandate for healthcare workers to get vaxxed. Peloton fires back at its portrayal in the Sex and the City reboot with its own parody ad. Spoiler alert, Mr. Big is alive and Peloton's stock price is trying to recover. And still looking for that perfect last-minute holiday gift, but want to avoid supply chain snafus? How about stuffing their stocking with some crypto and NFTs? We have an expert along to tell us how to do it. We're going to get to those stories in just a moment, everyone. But first, welcome to Yahoo Finance Live. I'm Alexis Christoforous here with my co-host, Karina Mitchell. And we want to take a look at the markets first because, Karina, looks like investors sitting tight, sitting on the sidelines here ahead of the final Federal Reserve meeting of 2021.
Looks like that, Alexis. A major benchmark slowing their roll a little bit as investors turn risk off. That's after the S&P hit that record high on Friday. So if we check really quickly, the Dow now down by 331 points. The S&P is off by 31 points. And NASDAQ taking one of the biggest hits. Apple, one of the laggards, moving a little further away from that $3 trillion market cap. NASDAQ now down by 162 points. Healthcare, one of the leading sectors, but here watching more of what's going on in the markets is our Yahoo Finance's Ines Ferre.
And Karina, if we just take a look at the NASDAQ 100, we've been watching shares of Tesla trading at their lowest level since October. Take a look, Tesla down about 5%, more than 5% right now. trading below its 50-day moving average, and traders say that this is important because it's commonly seen as a warning sign. So if it closes below that 50-day moving average, this could signal some selling ahead. Taking a look also at Apple. Apple is down about 0.2%. It had opened in the green. Apple has been on watch really for us as it's been going towards that $3 trillion market cap of value, but it had opened earlier higher, and now it's down slightly. Also, I want to mention JP Morgan put the street high price target on Apple of $210. Taking a look also at Bitcoin, we've been watching Bitcoin declining, entering its fifth straight week of losses. Bitcoin hovering around the 47,500 level. It briefly dipped below the 47,000 level. Now it's about 30% lower from its record high earlier in November. And then finally, just taking a look at the meme stocks, we've been watching AMC shares and also GameStop shares just plunging. GME down 12% today, and AMC adding to its losses from last week, it down 15% today, but last Friday it closed 7% lower. Intraday was down about 9%. CEO Adam Aron has been selling shares of the company, something that he had telegraphed earlier, but certainly the meme stock, so to speak, there's very little appetite for risky assets, and over the last month, you can see their performance. AMC down 42% over a 1-month chart. GME down 31%. Karina, Alexis.
All right, thanks a lot. Lots of red there on that screen. And as I want to stick with the markets and welcome in Brian Jacobson, Senior Investment Strategist at Allspring Global Investments. Brian, welcome to the show. Of course, we want to get into the Fed and expectations for later in the week. But first, just your take on the aggressive selling we're seeing here on Wall Street to start the week. What do you think the momentum is today?
I think that a lot of the story right now is waiting and watching for what central banks are going to do, but then also reacting to some of the somewhat negative news around the spread of the Omicron virus. You know, we see the enhanced lockdowns in different countries, in the United Kingdom flagging it as a risk. So I think it's really this push-pull kind of market where you have anticipation, expectation, optimism about what 2022 might hold, but unfortunately we got to get there first. And there are a few hurdles in our way, Omicron being one, and then the other one, of course, being any sort of shift in central bank rhetoric or policy.
And then, so the Fed has been stuck, as you say, between a rock and a hard place in your notes. And how delicate a dance are they playing at this moment leading up to that 2-day policy? Because obviously they're trying to buy time now. It's expected that they will taper quickly and then have the luxury of a little bit of time to decide when they hike rates. When do you see those rate hikes coming?
Yeah, as far as the actual timing of the rate hikes, I think that the Fed wants some flexibility as to when they're able to do it. If the data supports it, they would like to do it a little bit sooner, let's say May, but otherwise, my base case scenario is that it's going to be likely June and then again in December, assuming that financial conditions don't tighten too abruptly in response to that initial hike. And if you think about the tapering program, that in itself really is a crisis era response, and they feel comfortable withdrawing some of that support. But that doesn't mean that they necessarily need to at the next meeting or even at the same meeting that they wrap up the tapering is to hike rates. It's kind of incredible to me when I read a lot of the sell side commentary, the extent to which a lot of those investment banks have jumped onto the almost triple hike bandwagon. The idea that, oh, they're not going to hike at all in 2022, to suddenly, oh, now we're going to pencil in 3 hikes for 2022. And if you think about the hawks versus the doves on the Fed and changing the tone, birds don't change their feathers that quickly. And I don't think that the Fed is going to suddenly go from tapering to saying that, hey, now we need to start hiking 3 or 4 times next year. So I think that right now we have a little bit of angst and anxiety around what they might do, the signaling, but I'm pretty confident that the Fed is really going to try to take it slow when it comes to actually hiking rates.
I want to talk about what you're liking in 2022 in terms of sectors, but also in terms of markets. I mean, emerging markets have sort of taken a back seat over these past few months. Do you see them taking sort of a leadership position in the new year? And if so, Brian, where?
Yeah, we do expect that. Right now, I think emerging markets have taken a leadership position from headlines. If you look at things going on in, say, Turkey, and then in Brazil, and in China. Now, when will they actually have their day as far as taking the lead in terms of the market? And we think that 2022 could be a good year broadly for the emerging markets, although with a couple caveats. We're still not all that optimistic about the market outlook broadly for China. We do like China, and we think that there are some tremendous opportunities if you're doing more stock selection, and so we like working with individual portfolio managers who can sort of navigate this environment as the government tries to probably provide some stimulus, but they also want to make sure that it's an inclusive growth environment. And that could be a little bit more challenging to navigate than in the old days when you could just buy some sort of index tracking product and invest there comfortably. So we do like the emerging markets, but we would have to say that it's more along the lines of EM ex China, and then treat China more as a bit of a wild card in the portfolio.
And then, Brian, I want to turn your attention to the labor market, obviously very tight right now. So where do we see wage inflation going? Because I just read a survey where 99% of employers say they're considering giving their employees some sort of raise next year to try and keep up with inflation. So what does that do to companies that are, to their margins that are, sort of labor intensive? And then what does that do to the inflation picture overall? When does it start to ease?
Yeah, well, we actually think that the inflationary pressure is going to begin easing as we get these supply chain issues slowly resolving. The issues themselves are really idiosyncratic depending upon the company and the sector, but broadly for the economy as a whole, we actually think that we're probably going to see the improvement on the inflation front already with the data that will be coming out at the beginning of January for the consumer price index. So we're looking at those month-on-month improvements, not necessarily year-on-year changes. Those numbers can be really distorted by what are called the base effects. But the month-on-month improvement we think should improve as the year comes to a close and then as we get through 2022. Now, for companies, that does present a bit of a pickle, especially for those that are more service-oriented, that have labor costs as a bigger part of the costs of the services that they're providing. What does that mean for their profit margins? Wages tend to be lagging of inflation, and we don't think the wage increases are going to necessarily reinforce the consumer price inflation that we've seen. If anything, we think that productivity improvements will have a rebound. And so the key metrics to really be watching will be what's called unit labor costs. So it only comes out quarterly, unfortunately, and it wasn't that great in the third quarter, but that is actually kind of a productivity adjusted way of looking at wages, because it's fine to pay higher wages. It doesn't have to be inflationary as long as productivity has improved along with it. So we actually think that could be kind of the big thing for 2022 is a nice surge in productivity. So even if we get this wage growth, it doesn't necessarily have to feed into consumer price inflation because productivity is likely to more than offset that inflationary impulse.
So Brian, how does that play out though for small and mid-cap stocks and companies where inflationary pressures, wage increases could have a material impact on their profit margins? We know that the Russell 2000 was near bear territory recently. They've had a tough go of it these past few weeks. What's your outlook for those small and mid-cap stocks next year?
Yeah, we're actually looking for a rebound because we actually believe that the market has been forward-looking on this, anticipating that there was going to be that profit margin compression for those small to mid-cap companies, because if you look at their cost structure kind of across the sectors, when comparing large to mid to small, with small cap stocks, they tend to have labor costs as a larger part of their cost structure. And so we actually think that the market has actually already kind of priced that profit margin compression in. So we're not too worried about it. And that's one of the reasons why we've been rotating more into small caps as it did enter into a bear market. We don't think that this bear market is really going to persist through 2022 for small caps. We're anticipating a decent rebound.
All right, Brian Jacobson of Allspring Global Investments. Thanks for being with us and kicking off the week here on Yahoo Finance Live. You can always step up your investment strategy. You can do that starting today with a free 14-day trial of Yahoo Finance Plus. Get expert research reports, actionable investment ideas, advanced portfolio tools, and a whole lot more in a sleek ad-light experience. You can check it all out at yahoofinance.com/plus. The UK reports its first death tied to the Omicron variant as new cases of that variant rise in the country. Up next, we're going to speak with a doctor about what's next in our fight against COVID. Welcome back to Yahoo Finance. Well, the U.S. just marked another grim milestone on the COVID front. 800,000 people have now died from the virus in this country. That as the U.K. reported its first death tied to the Omicron variant and says 40% of COVID cases there are now attributed to the variant. UK Prime Minister Boris Johnson weighing in on its severity. Take a listen.
Sadly, yes, Omicron is reducing hospitalizations and sadly, at least one patient has now been confirmed to have died with Omicron. So I think the idea that this is somehow a milder version of the virus, I think that's something we need to set on one side and just recognize the sheer pace at which it accelerates through the population.
Here with her insight is Suzanne Judd, PhD epidemiologist at the University of Alabama at the Birmingham School of Public Health. Doctor, thank you so much for your time today. Just want to ask you to weigh in on those comments from the UK Prime Minister saying that comments that it is a milder variant. We should hold off on saying that at this point.
Absolutely. The reality is, if it is a milder variant, let's say that 10% fewer people wind up in the hospital. Well, if it spreads through the population at 10 times the rate, that actually leads to the same number of hospitalizations and potentially deaths. So that what he said is exactly right. We just don't know what the population level impact will be. So even if fewer people wind up in the hospital, we really can't say that it's a milder variant or that people won't wind up dying, because obviously, as we're seeing in the UK, there are still some people that will die from this variant.
Well, having said that, doctor, what do you make of the fact that some of the largest hospital systems in this country have now dropped their COVID mandate? I know that there's been a labor crunch, and the pandemic and these vaccine mandates have just added to it. We also had this judge put a stay on the Biden administration's efforts to implement that vaccine mandate for healthcare workers. Is that the right decision, do you think?
It may make sense from, say, a financial or a logistics standpoint, but from a public health standpoint, it doesn't. Because what the public might wind up hearing is that the vaccine is not required, that it's not necessary. But the vaccine is our #1 strategy for ending this pandemic. We know that folks that are vaccinated are much less likely to wind up in the hospital and much less likely to die if they are infected with COVID. So it's really important that we continue pushing, that we discuss the safety of the vaccines and the importance of everyone, especially in the healthcare sector, of being vaccinated.
Doctor, are we testing enough in this country?
No, that's actually one of the things the United States is not doing very well. We don't have enough access to readily available antigen testing, which is a very fast 15-minute test. Many other countries you can test from home. It's very easy to get these kits. We need those more available and at very low cost so that people are willing to purchase them and take the test at the first sign of symptoms. This will keep people that are not feeling well from going out, even if it's a mild, they might have just the sniffles. If they take one of these tests and find out they have COVID, hopefully they'll stay home and prevent the transmission further.
But doctor, how reliable are those tests? I mean, I myself personally have had to get tested for certain things, and they've said, well, we want the PCR test, the one that gets sent out to the lab. You don't get the results for at least 24 to 48 hours because it is a more reliable test. And also, can we actually test our way out of the pandemic?
We can't just test our way out of the pandemic. We really need the vaccine as well. But the testing is key to stopping some of the transmission. It's not a 100% guarantee if you're negative that it actually shows up negative. But in people that are symptomatic, that antigen test that you can get over the counter at the pharmacy, it's actually a pretty good test, and it's going to catch most of the COVID cases. So if it keeps 10, say, out of 20 that are potentially symptomatic out of population, that's huge for controlling the pandemic.
And Doctor, what is your opinion about whether the goalpost needs to change? Right now, the federal stance is if you have 2 vaccinations of the mRNA, then you are considered fully vaccinated, not the booster shot. Do you think that will change? Do you think it should change?
I do think it will change. The data are becoming clearer and clearer that 3rd shot really provides an extra boost of immunity. We've seen some great results with the Pfizer vaccine and the Omicron variant. So as we continue to collect data, I do think at the end of the day, you'll see a 3 vaccine regimen, which is actually quite normal for many of the vaccination schedules we have out there. But we still need a little more data before we can say definitively today it should be 3 vaccines.
And doctor, what about people who make the argument, especially those who are, against vaccinations, who say, look, if I have to continue to wear a mask even after I'm vaccinated, why should I get vaccinated? I've heard people make that argument.
Yeah, that's one of those things that's understandable. So everybody wants to remove the mask, but the reality is that in order to end the pandemic, we need masking, we need vaccination. We need to get to the point that the transmission levels are low enough that it is safe to take the mask off. And that's just going to take time. The vaccine is not a reward. It's not a reward. You can take your mask off. You've been vaccinated. The reward is getting out of this and having everybody be safe. And that's just going to take time, and it's going to take more people vaccinated than what we currently have.
Well, it will be interesting to see, even with all of these plans in place, if there is a surge in cases after the holidays. We'll have to wait and see. We'll leave it there. Suzanne Judd, PhD, epidemiologist at the University of Alabama at Birmingham School of Public Health. Thank you so much for your insight today. We've got much more coming up in this show. After a quick break, a conversation with the CEO of Getty Images on the company's plan to use a SPAC to go public.
Welcome back. Well, you see their images in just about every newspaper and magazine, and now Getty Images is going public again, this time with a blank check company called Neuberger Principal Holdings II. Getty Images CEO Craig Peters sat down with Yahoo Finance Live earlier to discuss coming to the public markets again.
The timing is that the business is performing incredibly well. We feel really good about the prospects of this business. And ultimately, we're playing into an incredibly visual future. And, our business is helping customers like Yahoo, play into that visual landscape and compete. And so we feel really good about the business. And so that was really what drove the timing. On the transaction itself, we looked at a variety of options, traditional IPO, SPAC, and to be candid, as we entered this, we were really thinking we would probably go down the traditional IPO route. However, we found a partner in CC Neuberger, which was really unique. They've provided a level of capital certainty to this deal, along with our existing shareholders in the Getty family and Cook Equity Development. It accumulates to about $800 million worth of capital certainty. And that's really unique, I think, when you look at the SPAC landscape and the transactions that are out there. And so for that reason, the certainty of that transaction, the quality of the partners that we are adding in CC Neuberger alongside our existing long-term shareholders, we felt really good about this transaction, combined again with our prospects for the business going forward.
And Craig, also unique to this deal, I would say, is that you're making money, a good sum of money, and in many respects do have a wide moat around what you do. 73% gross margins estimated this year, 32% adjusted operating margins. I mean, that is impressive stuff. What is driving your business right now?
Well, it really goes back to that visual landscape. The world is increasingly visual. Businesses need to be online. They need to be online in a variety of places, social media, advertising. Obviously, they need to maintain a web presence, a mobile presence, etc. And that's a challenging thing to do. And Getty Images is helping not only media businesses, not only ad agencies, but increasingly the corporate market do that. From the largest enterprises down to the smallest small businesses. And that's really driving our business. You think about, today, a small business needs to look like a big business online, and they need to be everywhere a big business is. And so through our iStock brand, we're really helping
those small businesses do that. And then through our Unsplash acquisition, which we made in April of this year, we're really extending that out even further to the semi-professional creator and that creative long tail. So just a lot of opportunity for the business, which is driving our growth and ultimately driving a lot of the financials that you referenced.
So Craig, talking about that the different sort of levels that you guys have, price points that you have in those different business offerings. You also mentioned in the investment presentation that you might use some of these proceeds to go out and make more acquisitions. Where will those fit in? Will they fit in price point? Will they fit in terms of expanding the library at Getty? Where are you looking to maybe plug holes or expand in the business?
Well, I think we feel really good about the footprint we have right now. We do believe we cover the full market opportunity in terms of the enterprise, the small businesses, and then that creative long tail. And we feel really good about the organic growth opportunities that sit in this business. We feel great about the corporate market and how we're growing there. We feel great about video and the growth that's generating in this business. We believe we can market more aggressively to continue to grow our new customers and ultimately new business. But there may be opportunities to do further acquisitions, and I think we'll look at them selectively. I don't think this is a M&A strategy. I think it's one where we're largely focused on our organic strategy, but there might be opportunities to accelerate geographic penetration or certain content opportunities as they arise. But we'll see those as they present themselves.
Greg, I can't think of too many businesses better positioned to launch an NFT strategy. Is that in your plans for next year?
It's something we're looking at, and we certainly see our assets. We're an intellectual property owner, which is pretty unique in our space. We actually own and produce a lot of the content that we distribute. And with our archive that really goes back to the start of visual imagery, we see that as an asset that can play into that. It's certainly, it's not embedded in our financials today. The growth that we produce and the profitability that we produce and the customers that we serve, continue to drive this business. But we do think it's something that can add to this business over time. Whether it adds to this business meaningfully in 2022 or even 2023, yet to see. We're going to take it cautiously as we do sit on, again, a wealth of intellectual property. We want to make sure that we're going to market in the right ways around NFTs, but we do see it as an opportunity going forward.
And Craig, I've talked to a few people who are familiar with Getty, and they all point to your company having a very unique culture and in many respects being a secret weapon to Getty. So how do you describe your company's internal culture?
It is unique. We start with a mission that we want to move the world. We believe that as a business, we can do bigger and better things and really have an impact across the world. And whether that's covering the U.S. border crisis, covering floods and natural disasters, or really representing underrepresented communities in a positive way, we fundamentally think we can have an impact, a positive impact against the world. So I think that mission is a binding one into this business. And then I think we all hold ourselves accountable to what we call our leadership principles, but they're really intended to make sure that everybody can come into this business and give their very best. And it's an important part of this business, and it's one that in this environment of the Great Resignation, we're seeing employee turnover at 5% or less. And I think that's a real tribute to our mission and ultimately to the values that we all try to own and represent.
That was Getty Images CEO Craig Peters. Coming up next, how to get crypto and NFTs as stocking stuffers this holiday season. What you need to know up next.
Welcome back to Yahoo Finance. Well, if supply chain issues are throwing a wrench into your holiday gift-giving plan, you may want to try giving a present that gets around that. To discuss some Web3 gift ideas is Caleb Solver joining us. Thank you so much for being with us, sir. And so I never actually realized that you could gift crypto using a gift card. The only caveat is that how much you spend on it may not be what it's worth when the recipient opens it, right? But if you do decide to go that route, go ahead.
$100, it may be worth 75 in 5 minutes, or maybe worth 200 in 5 minutes. But this is a supply chain proof gift. You can't count on the price all the time, but it's never been easier to give digital gifts, especially in 2022. So one of the ways to do that is through a digital gift giving card. They're easy to buy. All the exchanges are offering them. We have some retailers exchanging them. The key is that the recipient needs a wallet or needs an account where they can redeem that. Another way to give it is basically wallet to wallet. You can transfer crypto wallet to wallet, one gift giver to the next, or you can give via a crypto exchange. And all of the exchanges allow peer-to-peer gifting. Coinbase does it, Binance.com, Crypto.com, you name it. Couldn't be easier to transfer crypto as a gift either. The whole key, though, is that you got to have a wallet on the recipient side and obviously on the giver side too, Karina.
Right. Hey, Caleb, good to see you. Alexis here. I know that you need to find somewhere safe to store that gift, right? To store that digital asset. How do you go about doing that, especially if you want it to be a surprise for the person? And also talk to us a little bit about the tax consequences here, which can be very confusing for folks if you gift something like a crypto or even an NFT to someone.
Yeah, great to be with you, Alexis. And let's start with the taxes because you got to treat it like a stock. There is no gift tax if it's under $15,000 for an individual or $30,000 for a couple. No gift tax on the giver side. If you get the crypto, and then we'll talk about how to get that in your wallet, but if you're the recipient of it and the crypto goes up over time, let's say it increases 50% over the next few months, and you sell it, you're subject to short-term capital gains tax, just like if you sold the stock before a year. If you hold it a year and you sell it at a profit, you're subject to those long-term capital gains tax. So it's not tax-proof, you're going to have to pay tax if you sell it for a profit. Now, you have to have a wallet, whether that's a wallet on an exchange like a Coinbase or a crypto.com, or a cold wallet, your own wallet offline with your own digital code. If you're going to get any type of crypto gift, you need one of those. So if you want to surprise somebody, you have to tell them you have to set up a wallet in order for me to give you this gift, but the gift is that I'll be giving you X amount of dollars worth of Bitcoin. You just need a wallet on both sides. That's how cryptocurrencies are transferred.
And are there particular types of crypto that make a better gift? And I know that you can also give physical coins as well.
Yeah, you can give physical coins, and I think the gifts that are the easiest to give are the ones that are the most popular coins that are transferable or traded on the major exchanges. You know, not all exchanges have all coins. There's so many coins out there. So the more obscure the coin that you give, the harder it might be to find a way for the recipient to get it. On the other hand, you see the big popular ones getting gifted all the time. Ethereum is a real popular one. Bitcoin, obviously itself, the Polkadot one, the Dogecoins of the world. You see those get traded and given all the time. So yeah, you got to keep that in mind when you're giving. Make sure it's accessible to the person who's going to get it.
What about those non-fungible tokens or NFTs, Caleb? Do the same rules apply? What should you make sure you do before gifting those?
Yeah, that's a great question. It's very similar to cryptocurrency, but again, you're going to need digital wallets to accept any NFT as a gift. And if you're the giver or you want to give an NFT, you have to have a collection, a digital collection already. So you already have to own the digital assets, the NFTs, and have your own collection from which to give to somebody else. But that recipient, again, needs a wallet. You can do this on these marketplaces like OpenSea, Larva Labs, the Nifty Gateway. There's such cool names on all these new exchanges, and people are giving each other digital gifts and NFTs like crazy on these right now, especially around the holiday season. You just got to make sure you have that wallet, and the same tax rules apply, Alexis. If you sell it at a profit within a year, short-term capital gains. If you sell it for a profit after a year, long-term capital gains. But you can give it, just like stock, just like crypto, just like NFTs, to a spouse without any tax consequences at all. So if you want to give your sweetheart a little cryptocurrency or an NFT for the holiday season, no tax consequences at all. Make a fun gift, be fun to share together with the family.
Okay, I want to ask you, sometimes a gift is really difficult once you receive it. It's easy to give, but then the recipient, if it's a toy, you spend hours putting the batteries in, or if it's electronic, you set it up. How easy is it for the recipient to then receive and then be able to use it or trade it as an asset?
It's all dependent. It's a great question. Nobody likes to get cryptocurrency that they can't use, but it's all dependent on the recipient having that digital wallet and establishing that account so that they can actually receive it. They can transfer it to another cryptocurrency if they want via trade, or they can cash it in if they want to take the money to pull cash off the table. But if they don't have a digital wallet established, it's very difficult. And that's difficult for kids under 18. Sometimes parents may have to set up a custodian account, although some crypto brokers are allowing that joint tenancy of an account for kids if they want to get that crypto gift. Set one up for your kids in their name, set one up for your nephews, your nieces, or your grandkids with a digital ID. Then they can start getting those digital currencies or those NFTs as holiday presents.
All right, we will have to leave it there. Caleb Silver, Investopedia's EIC, thank you so much for your insight today. And we have much more coming up after a quick break. If you're planning to retire soon, you will want to stick around. We'll tell you what you need to know to ensure the next phase of their retirement gets off to a smooth start.
The Great Resignation has led to a rise in the number of people retiring during the pandemic. Well, if you're looking to leave the workforce in the new year, there are some things you should be doing right now to prepare for a smooth transition. Here to walk us through it is Catherine George, financial advisor at WealthStream Advisors. Catherine, good to have you here. This is on lots of people's minds, some people looking to leave the workforce next year. What's the first thing they should be doing right now?
You know, a lot of people come to me and they're scared because we spend most of our time accumulating assets, and once you have to start decumulating, it can be scary. So one of the main questions that I get is, can I afford to retire? Can we take those extra vacations? Can I buy that second home? And I think the backbone of feeling comfortable in retirement is working with a fiduciary financial advisor to come up with a projection. So there's software where you can take your income, your expenses, all the assets that you have, project it out into the future to see what trajectory you're on. And that can really, be a great guide to see if you are spending too much or if you can afford that extra trip. That's the first tip.
And Catherine, it's great to have a financial planner or advisor. Sometimes they are very busy. Sometimes they can cost a lot of money. So what can people do before going to one? What are steps they can take on their own to make sure that they position themselves well for retirement?
It's a great question. I think the biggest thing that you can do is establish a cash reserve, and not only establish it, but come up with a plan to maintain it over time. Think about what income you'll have and how much you spend on a monthly or annual basis, and what you'll need to supplement your lifestyle on a monthly, quarterly, or annual basis. Once you determine that, you can have a cash reserve from anywhere to a year or even more of cash, and come up with a plan of, once my target hits half of what it is, can I rebalance my portfolio, sell some stocks, and top that cash off, or is the market down? And I think that the key position to be in is to not be in a place where you're out of cash and the stock market's down and you're going to have to pull from a bad market and a time where you wouldn't be able to recoup your money if you sold. So I think staying ahead of that, having enough cash to withstand the ups and downs of the stock market is crucial once you're in retirement.
And Catherine, I just want to know, talking about that cash reserve, of course you want to weather the market ups and downs, as you just said, but what should those cash reserves be used for? How do they get apportioned?
So for your monthly needs, once your income has stopped and you're not receiving a paycheck, you're going to have to pay yourself from your investment account, from your savings account. And instead of selling stocks as you need them, having the guarantee that that cash is there and that it's ready for you, and if there's an emergency that comes up, you have it, is the most important thing. So paying yourself from your cash account, and then once it starts to get to a certain level, look at your portfolio, see if there's a place where you can top it off, and if it's an appropriate time.
And Catherine, what are some tax considerations you should be thinking about when you're looking to draw upon some of those retirement funds?
So there's two main different types of accounts that we all have, and especially once we exit retirement, is your retirement accounts. So your company 401ks, and kind of a side note, one thing that I see a lot from our clients or prospects is that there's all of these small retirement accounts all over, and it's really important to kind of know what accounts you have and keep track of everything. But your retirement accounts are taxed at what's called ordinary income rates, so just like your salary at your company. Whereas taxable accounts, say an individual account or a joint account, those are taxed at capital gains rates, which is anywhere from 0 to 30%, pending state and city taxes. So it's much preferential to kind of figure out where you're going to do that. You can either work with an accountant or an advisor, or just kind of think about where is my tax bracket and which buckets make the most sense to pull from right now.
What do you think is the biggest mistake people who are about to retire make? Access to information that they should know, but they don't.
I think really it's the cash, and then there's little things that you can do, like maintaining your accounts. I've seen people put cash in a Roth account and not invest it. So really making sure that you know where your accounts are, what's in your accounts, and that you're maximizing all of your benefits. So any pensions that your employer offered, or anything else that that you have an opportunity to take advantage of. But one of the other things that is really important is now a lot of employers are offering what's called Roth, or after-tax 401k savings. And if you keep this in the employer 401k, any growth on your after-tax or Roth savings kind of gets stuck back into a pre-tax IRA account. So, a lot of jargon to say that it's really beneficial as soon as you can to take any after-tax or Roth savings from your 401k and roll it into a Roth IRA, so that all of the growth can stay tax-free and in your pockets.
Good advice, lots to consider there. Another thing, while you're getting that all in order, make sure you have beneficiaries on all those accounts, right? We sometimes forget to do that. Catherine George of WealthStream Advisors, thanks so much. Coming up next, Peloton responds to that Sex and the City reboot shocker, but what's it doing for the company's stock? We'll talk about it right after this.
Welcome back to Yahoo Finance. Spoiler alert. Well, you probably would be in the minority if you hadn't heard something by now surrounding a controversy about a big plot twist in the new reboot of Sex and the City, which debuted last week on HBO Max. Peloton stock is up now by about 1%. It was up by about 2.6% earlier in the day, but Peloton was, shall we say, unfavorably cast in that episode, and its stock tanked on Friday in part due to the negative publicity surrounding the debut episode. But now it may have the last laugh riding on the coattails of the controversy and a comeback ad. Take a look.
To new beginnings.
To new beginnings. You look great.
Oh, I feel great. Should we take another ride? Life's too short not to.
Just like that, the world was reminded that regular cycling stimulates and improves your heart, lungs, and circulation, reducing your risk of cardiovascular diseases. Cycling strengthens your heart muscles, lowers resting pulse, and reduces blood fat levels. He's alive.
Here to help bring us up to speed is Yahoo Finance's Brian Sazi. Brian, just like that, and they say all publicity is good publicity.
Well, I have to say, I did look at my treadmill at the gym a lot differently this week in there, worried if I would get off it alive, but I'm here, I'm here, so suffice to say, I did make it off the treadmill alive. You know, and there's been some talk out there that Peloton staged this. I'm reading a new thread right now on LinkedIn from their chief marketing officer,